I believe, make no mistake, that over 10 years, the gold price, the nominal gold price is going to be markedly higher than it is today. I think the fact that I'm able to buy high quality companies at fair prices in a market that I think gets inexorably better is very attractive. The things that are denominated in US dollars, like gold, will be soft, a panic engendered market. You'll just have to see what's cheaper. The opportunity that's most attractive to me is the gold stock market. Gold stocks are, relative to the gold price, not cheap, but they're fairly priced. And they've been fairly priced maybe 4 times in my career. The interest rate wants to go up, and the government is doing whatever they can by buying the long end of the yield curve and financing it out of the short end of the yield curve. There's a lot of people, myself included, who are willing to buy 1-year paper. Government is financing 1-year paper to buy back 10-year paper. The market might now look at the Fed and say, you don't have the ability to do what it takes. You can't raise taxes. You can't increase the deficit. If you bail out the system, you have to print. If you print, that's going to be wildly inflationary. But when people ask me what makes me the most afraid,
it's not a mystery that gold has come down from its highs. It's also not a mystery for those of us observing the space that sentiment in this mining space has come down significantly from just a few months ago, right? We talked about this a lot, but it's interesting for me to observe that even though the price point of gold was exactly the same, maybe last October or something like that, sentiment is completely different. How can sentiment be completely different at the same price point?
I think that people are emotional rather than rational creatures. Yeah. Developing a rational approach requires work. An emotional approach just requires feelings, and it's easier to feel than it is to think. But most people do what's easy. We try here to teach people how to think. What you point out is probably the greatest part of this timing. I was afraid in December and January of this year that I would assemble 68 great companies and have to say from the podium, these are 68 great companies, but none of them are cheap. The fact that the junior resource market is sold off by 40%, and the fact that the bad companies and the good companies are sold off in frankly equal measure shields me from that problem. Mm-hmm. I can say we have 68 exhibitors and there's some spectacular value on our floor. That spectacular value exists because the sentiment in the sector is bad.
Yeah. We're entering the second half of 2026. Fundamentally for an investor, not just in the metals and mining space, but just any investor, how do you expect the second half of 2026 to impact your portfolio differently than the first half?
Gold is trading near familiar levels, yet investor confidence has collapsed as if the bull market already ended. Rick Rule notes that a 40% decline across junior miners has punished exceptional businesses alongside weak ones, exposing emotional rather than rational pricing. That disconnect is exactly where institutions quietly accumulate, while retail abandons conviction. Patient investors often profit from fear, not excitement. Next, Rick Rule reveals why today's pessimism could become tomorrow's biggest valuation advantage.
I suspect it's going to be very soft in the second half for 2 reasons. I think there's less pressure on the US Fed to lower interest rates. I think ultimately they will, but I don't think they'll have to in calendar 2026. That means relatively strong US dollar. That means that things that are denominated in US dollars, like gold, will be soft in terms of price. I also think, and I'm making this next part up, David, so I hope your people don't take me too seriously, but I think the recent conflict that we had in the Gulf acted like a tax. And as you know, I think all taxes are bad. What happened with high oil prices is that we took a lot of liquidity out of the economy. And I think that the economy in the second half of 2026 is going to surprise people with its weakness. What that means is that I expect, as an example, the copper quote to be flat to down. I expect what you're seeing in the oil market, because the high oil price, among other things, killed some demand. So I suspect that 2026 is not going to be kind for people who are impatient. For people who are patient, I think that you're going to have the ability to buy names that are high quality names, that you're going to have enough time to study them before you buy them, and you're going to set yourself up to make a boatload of money in the out years.
Mm-hmm. What about financial stocks? given that interest rates were rising? Do financial stocks usually perform better or worse during a rising interest rate environment, especially when the yield curve flattens out?
The strongest investment opportunities often appear precisely when economic momentum quietly begins fading beneath the headlines. According to Rick Rule, a resilient dollar and slower Federal Reserve easing could pressure commodities before the next major advance begins. Markets rarely reward impatience because liquidity cycles usually shift well before public sentiment catches up. Investors focused only on today's prices risk missing tomorrow's accumulation window. Next, Rick Rule exposes the overlooked timing signal, separating temporary weakness from lasting opportunity.
Rising interest rate environments traditionally are lousy for conventional financial services companies.
Okay.
I think it'll depend on where you inhabit that ecosystem. There are, and this is not in this particular instance an advertisement for Battle Bank, there are some community banks in the U.S., small banks, that know their local market well, serve their local market well, have no loan loss experience whatsoever, selling at 60% a book and earning 10 or 12% on capital after tax. That's a 15% after tax earnings yield if you buy it at 60% a book. That's a no-brainer. I mean, it's an absolute no-brainer. And those are banks that traditionally are run by bankers who serve through good interest rates and bad. Most people get bored with the concept of the property and casualty insurer or a community bank. Mm-hmm. But the idea that you can buy a 10 or 12% stable after-tax yield at 60% a book, pretty attractive. Those companies will do well.
There are some risks that we have to discuss. I think you've discussed the possibility that mom and pop owned high yield bond ETFs could trigger what could be a run of the bank, except without the FDIC to backstop it. Yeah. Can you tell us more?
If I had to think about one thing that really scares me, that's it. You see a circumstance where if the Fed doesn't intervene, the interest rate wants to go higher. It wants to go higher.
The investments most people ignore are sometimes the ones protecting wealth when markets become unstable. What Rick Rule is highlighting is that select community banks remain deeply discounted despite generating consistent returns, while speculative capital chases fashionable sectors. The bigger concern is rising rates, quietly increasing pressure across leveraged credit markets beneath the surface. Understanding where value actually exists can matter more than following headlines. Next, Rick Rule reveals the hidden weakness inside supposedly diversified income investments.
And higher interest rate does a couple things. It hampers the ability of stressed creditors to pay. If they had trouble at 7, they're going to have a lot of trouble at 9. And it also constricts credit. It also devalues the long bond because that long bond can be replaced at a different interest yield. If you are already experiencing credit difficulties, higher interest rates are difficult for you. In answer to your specific question, what scares me is the high yield ETFs, the junk bond, the subprime credit ETFs, have literally trillions of dollars of assets, and many of them are owned by people who don't understand the credit risk that they're taking. If people begin to have credit concerns and begin to sell those ETFs, the ETF structure itself is highly liquid, but the assets in the ETFs aren't liquid. The manager will have to sell assets which he or she can't sell to fund redemptions, which they must fund. That's where the run on the bank comes. There are some high yield bonds that were sold over the counter in these ETFs that trade once every 6 weeks. If you have to push that bond into the market overnight to fund a redemption, the price that you're going to sell that bond for is going to reflect your distress, not just the market's distress. And that really scares me. Really, truly scares me.
But the trigger for that would be much higher rates, you think?
People are already concerned about private credit markets.
Millions believe ETFs guarantee liquidity, but the underlying assets often tell a completely different story. Rick Rule's argument suggests the real danger emerges when investors rush to redeem funds holding securities that rarely trade under normal conditions. That mismatch can force distressed selling long before fundamental values are reached. Portfolio safety depends on understanding market structure, not simply owning popular products. Next, Rick Rule exposes why liquidity can disappear precisely when investors need it most.
If people's concern extends from private credit to junk credit, which it might, I'm not saying it's going to happen, but when people ask me what makes me the most afraid, I'm afraid that many retail investors don't understand the risks that they're running in their high yield bond portfolio. They don't understand the credits that they're writing. And if something happens like 2008 that causes them to be concerned, if they head for the exits, there's no exit.
But this concern is specifically for high yield bond investors. It's not a systemic risk that could propagate into other sectors.
Well, it could. If you have a circumstance where high yield ETFs gate, where they don't fund redemption, the nervousness that creates in the broad market, and I'm not saying this is going to happen, but if it happens, you revisit 2008. You might not, at your age, have been cognizant in 2008, but we had a real test of system failure. And that's a character building environment.
One could argue the entire system didn't collapse because the governments did backstop several large institutions.
That's exactly correct.
We can expect the same thing to happen again, right?
Except that in 2008, the aggregate debt of the U.S. federal government was about 40% of GDP. Now it's 120% of GDP. One wonders about the tools available. The Fed was able to say in 2008, we will do whatever it takes.
The next financial shock may begin where most investors believe diversification protects them. This is where Rick Rule's thesis shifts from isolated credit concerns toward broader systemic confidence, because panic spreads faster than defaults themselves. Government rescue tools exist, but today's debt burden leaves policymakers with far less flexibility than in 2008. Assuming every crisis receives the same response could prove dangerously expensive. Next, Rick Rule unravels why future bailouts may carry far greater inflationary consequences.
The market might now look at the Fed and say, you don't have the ability to do what it takes. You can't raise taxes. You can't increase the deficit. So if you bail out the system, you have to print. And if you print, that's going to be wildly inflationary, not merely inflationary. So the ability that the Fed has to intervene relative to the size of the problem is much lower now than it was in 2008. I'm not saying that they can't. And if it happens, they will. But the damage that they do to business confidence, to credit confidence, and in particular, to confidence in the sanctity of the US dollar is very, very risky.
So I guess the hard constraint here is inflation. There is nothing stopping the Fed from instituting unlimited QE like they did during COVID.
That's correct. What changes is their ability to fund it.
Right.
That's what changes. Remember that the debt to GDP, on balance sheet debt to GDP then, was 40%. On balance sheet debt to GDP is 115 or 120% before you take in the net present value of unfunded entitlement liabilities. There's much less flex in the system now.
Unless somehow they just lend to the banks without monetizing debt and the money supply doesn't really grow.
How? What's the instrument? I mean, the only instrument that works in that circumstance is something called a lie. And the market is not that naive. The market's fairly naive. But if the government says, we're going to kiss it and make it better, here's your kiss, where's the money?
The Federal Reserve can create money, but it cannot manufacture lasting confidence in a currency. Rick Rule notes that debt levels have roughly tripled relative to GDP since the last major crisis, fundamentally changing the cost of future rescues. Every bailout now carries greater inflation risk because fiscal flexibility has steadily eroded beneath reassuring headlines. Wealth preservation increasingly depends on recognizing that constraint early. Next, Rick Rule reveals what bond markets are already signaling about policy credibility.
So the bond market, the world's largest market after real estate, is telling us what now, Rick? If you look at the way spreads are behaving, yields are behaving, and
the interest rate wants to go up.
Yes.
And the government is doing whatever they can by buying the long end of the yield curve and financing it out of the short end of the yield curve They're doing whatever they can to maintain their control over the yield curve. Right now, because people are concerned about the broad economy, there's a lot of people, myself included, who are willing to buy one-year paper. The government is financing one-year paper to buy back 10-year paper to lower the long bond yield. But the long bond yields are still rising. What that's telling you is that investors want a time premium and they want a risk premium.
Going back to your previous comment about the second half of the year being softer, which opportunities would that present?
That depends on the scenario that we face. I know you want a yes or no answer, but I don't have one. If we have a market, a panic-engendered market, you'll just have to see what's cheaper. When I look across the opportunities that are presented to me, the opportunity that's most attractive to me, probably because I know it very well, is the gold stock market. The gold stocks are, relative to the gold price, not cheap, but they're fairly priced. And they've been fairly priced maybe 4 times in my career.
Bond markets usually recognize stress long before television commentators acknowledge it publicly. According to Rick Rule, investors demanding higher risk premiums despite government intervention suggest confidence is quietly weakening beneath the surface. When capital becomes more selective, fairly valued gold miners can suddenly become exceptional opportunities during periods of forced selling. Those prepared with liquidity gain advantages others cannot. Next, Rick Rule exposes why institutional money eventually returns to precious metals first.
I believe, make no mistake, that over 10 years, the gold price, the nominal gold price, is going to be markedly higher than it is today. And I think the fact that I'm able to buy high-quality companies at fair prices in a market that I think gets inexorably better is very attractive. I think right now that the oil quote and the oil stocks are in free fall. And the oil market is a better market than any other natural resource stock. So if I looked at what I'm likely to allocate to the most over the next 6 months, it's likely to be the oil and gas business. I'm able to do that because I know a lot about it. I grew up in that.
Canadian oil and gas specifically?
I am more willing than most people to buy Canadian oil and gas because I understand the valuations in Canadian oil and gas. American investors need to decide how much carny risk they're willing to take. My belief is that although Carney is frankly hostile to the oil and gas business, I think unlike your former prime minister, he can add and subtract. He understands that his domestic spending program requires revenue. And what Canada is better at than anything else is oil and gas. I think that he will have to be oil and gas friendly because I don't think there's any other way to fund his social program. And I think he understands that.
Mm-hmm. I think he has made some remarks recently that would support your point. He's trying to appease both sides, I think.
Yeah.
But at the same time,
I really pay less attention to what they say.
Mm-hmm.
I like that adage that you can tell when politicians are lying because their lips are moving. So I prefer to think about the fiscal and arithmetic constraints he operates on.
Yes.
More than what he has to say. I've been watching this guy for a very, very, very long time.
Mm-hmm.
He's a very bright guy. He's a very driven guy. Given that he got where he is, he's probably not a very honest guy. So I prefer not to listen to him, but rather watch him.
Political speeches rarely determine investment outcomes, but government balance sheets eventually do. What Rick Rule is highlighting is that fiscal arithmetic can force policymakers to support industries they publicly criticize because tax revenue becomes indispensable. Long-term investors should monitor incentives instead of headlines, since markets ultimately reward economic necessity over political messaging. Following actions instead of promises reduces costly emotional decisions.